It's my great pleasure to welcome you today to the Center for Global Finance Research Seminar on a very interesting topical, contemporary topic of towards a climate-just financial system, thereby integrating one of the top risk issues globally, which is a climate risk, into the financial system. This is indeed a contemporary issue, and we are delighted today to welcome one of the active researchers, indeed leading researchers in this particular area, and from SOAS, one of our own, Yannis Dafermos, who is a senior lecturer in economics at SOAS University of London. He's also the research convener in the university, in the Department of Economics, a senior fellow for one of the very active research centers here, which is the Center for Sustainable Finance. And he's also a fellow at the Forum for Macroeconomics and Macroeconomic Policies. He's very prolific, and especially driving the agenda of climate risk, climate finance, or climate in macro policy, and emphasizing issues of financial macroeconomics, climate finance, ecological macroeconomics, climate-aligned development, and inequality. And we've seen his work in a number of peer-reviewed journals, including the Cambridge Journal of Economics, Ecological Economics, Environmental Planning, New Political Economy, the Journal of Financial Stability. I could go on and on. His work is of great interest, and I'm sure that a number of people here in the audience will have seen some of his recent publications here. He's also been very active in terms of research funding, leading as principal investigator, as well as co-investigator on a number of projects, especially on climate, funded by Climate Works Foundation, the prestigious Economic and Social Research Council of the UK, and has also not only been actively teaching and researching, but also has been actively involved in capacity building programs on climate change in particular for a number of central banks. He's active in many forums, including a committee member of the Post-Keynesian Economic Society, a council member of the European Association for Evolutionary Political Economy, and a member of the editorial board of the journal Ecological Economics. I want also to emphasize the special nature of the meeting today. We thought we would not only have people dedicated from research at universities, but also researchers who are driving the policy and the impact of the policies at a central bank. And we have here Dr. Oswald Mungule and Dr. Jonathan Chipili from the Bank of Zambia, who have been both active within the Center for Global Finance at SOAS, but also have been very active in the African Economic Research Consortium. And I note from the audience that we are fortunate today to have a good representation from a number of central banks, including good friends, Dr. Annika Mau, including also Maureen Were, Dr. Maureen Were, both from the Central Bank of Kenya, and a number of policy aligned researchers from the UN, Awen Garang. So what is special about this seminar today is both the sharing of scientific work that Yannis will be sharing with us, but also the discussion and trying to align it with the challenges for policymakers from central banks and other financial institutions. So we are very fortunate. This is indeed an opportunity for the cut and thrust to share ideas, contributions, queries, questions. So let me call upon Yannis. Delighted you could be here. Let me call upon you to start the discussion. Yannis, please go ahead.
Thank you so much, Victor. It's a great pleasure to be here and to present my paper in the series of the Center for Global Finance. And first of all, let me thank you, Victor and Athena, for inviting me, for organizing this seminar. And also many thanks to Jonathan and Oswald for being happy to be the discussants for the paper. I very much look forward to their comments. And let me share my screen. So hopefully now you can see my screen.
Yes, yeah.
So I'm going to talk about climate finance, but I'm going specifically to focus on this issue from a global climate justice perspective, and I will explain a bit what I mean by that. Now, I have been working on climate finance for several years, and the purpose of this paper is basically to reflect on what I have seen over the last years in the academic literature about climate finance, but most crucially in policy making. And I would like to make a connection between climate justice and the financial system, because in my view, this is very important. And I will explain later why I think we have to focus on climate justice when we are talking about climate finance. And the paper that I'm going to present is basically a conceptual paper. So I'm not going to present you quantitative stuff and estimates and so on. But of course, what I'm going to present relies on a lot of work that has been done in the past about climate risks and about the different tools that central banks have used in order to deal with climate change. And the reason why it's so great for me to be here is that it's a paper that tries to analyze this issue from a conceptual perspective, but it's also a paper that tries to provide a direction for policy making. And I also have a little bit provocative recommendations, so I very much look forward to your criticisms and your comments. So let me get started by saying a couple of things about the motivation behind the paper. So over the last years, we have seen that many financial institutions around the world, and here I refer both to private financial institutions, but also public financial institutions like central banks and financial regulation authorities, have focused quite a lot on climate change. Now, a few years ago, this was not the case. I remember that, for instance, 7 or 8 years ago, it was very difficult to talk about climate change in financial communities. So people were not focusing so much on this issue, or central banks did not consider this as an issue that has to do with their mandates. This has changed completely over the last years. And one of the key reasons why central banks and financial supervisors in particular focus so much on climate change right now is because of the fact that this is considered to be, climate change is considered to be a source of climate risk. And therefore, many central banks have highlighted that they cannot ignore climate change. At the same time, we have seen a lot of attempts to support the process of what we call decarbonization. To give you an example, the European Central Bank has recently decided to incorporate climate criteria into their corporate bond purchases. This is part of their broader quantitative easing program. And basically, over the last months, they invest more in bonds that perform better from a climate perspective. Another example is the so-called climate stress testing. Many central banks around the world have already conducted climate stress tests. There are also central banks that might not have done that so far, but they have plans about doing so. So, for instance, in Southeast Asia now, at least 2 or 3 central banks are working in the direction of developing climate stress tests. We also have initiatives in terms of what we call collateral frameworks, which refer to the way that central banks provide liquidity to the financial system. So, for example, People's Bank of China has incorporated green bonds into their collateral frameworks. They have done this over the last 5 years or so. Bank of Japan has also incorporated some climate criteria into their refinancing operations. So there are a lot of things that are happening right now in central banking. But at the same time, we have seen a lot of initiatives in private finance. So there has been, of course, a lot of discussion about the role of environmental, social, and governance indicators. And many financial institutions now focus quite a lot on ESG when they decide about the allocation of their investment. More recently, we have seen an interest by credit rating agencies that have started developing approaches in order to quantify climate-related financial risks. And in the future, it's very likely that these evaluations of credit rating agencies are going to be reflected in the way that they assess countries and companies. But we have also seen, of course, a lot of initiatives related to investment banks and multilateral development banks that have tried to support more explicitly green lending. So many things are happening right now in the area of climate finance. And I will be very happy to talk more about that during our Q&A. But what I would like to highlight in my presentation is that in all these discussions, I cannot see any specific consideration of global climate justice issues. And first of all, let me explain what I mean in the context of this paper when I refer to global climate justice. I refer to the fact that according to the data that we have about greenhouse gas emissions, it is very clear that the contribution to the climate crisis problem comes primarily from high-income countries, and the contribution of countries that are in the so-called global south is much less compared to the contribution of countries in the global north. This is important because it means that, for instance, when we are talking about reducing emissions, it has been recognized in general that countries like the UK, European countries, the US have a responsibility to reduce their emissions much more quickly than countries in the global south. We also know that the climate events are much more frequent and severe in the global south in general. And for instance, if we look at data about the most important climate-related disasters, in most cases, these have taken place in small island developing states. We also have some indicators about climate vulnerability, and there are many reports about that. Here I refer to a specific report which shows that 9 out of 10 most climate vulnerable countries are in the global south. And this illustrates that despite the fact that many developing countries, for instance, do not have a significant responsibility for the climate crisis, they are experiencing the effects of climate change in a much more severe way compared to countries in the global north. This is an issue that has been accepted overall in the discussions about climate change. But of course, policy making hasn't been so much in line with this problem. And most crucially, for the purpose of this paper, I haven't seen any serious discussions about the role of global climate justice in the context of finance. Now, why is that important? I will argue that there are at least 3 reasons why we need to take into account global climate justice in the case of climate finance. One first reason that I think is very important is that if we don't do that, there is a risk that some climate finance initiatives will create more problems in the context of climate injustice. And let me give you one example in order to illustrate why this can be the case. We have now that there is a lot of discussion about the importance of incorporated climate risks into the evaluations of credit rating agencies. This is crucial from a climate risk perspective because these evaluations are used quite a lot across the financial system when, for instance, we have credit assessments of government bonds. Now, there are some recent reports from credit rating agencies that illustrate that if they incorporate the so-called physical risks of climate change, these are risks for the financial system that have to do with hurricanes, floods, droughts, and so on, countries, many developing countries, will see basically a downgrade because of the fact that they are more vulnerable to climate change. So one implication of credit rating agencies doing so is that many countries might see an increase in their cost of borrowing as a result of this incorporation of climate risks into the models of credit rating agencies. And I will give some more details about that later. But of course, it's a kind of an approach that we have some significant side effects for countries in the global south. A second reason why I think it's important to think about climate justice is the fact that one size does not fit all. And my experience so far is that this is not basically discussed seriously in climate finance circles, in the sense that what, for instance, the ECB does or the Bank of England does in terms of climate change is in most cases is suggested as a kind of a roadmap for many countries in Southeast Asia or Latin America, without taking into account that the conditions are very different in different countries. For instance, when we are talking about the way that we evaluate carbon-intensive activities, we cannot evaluate carbon-intensive activities in the same way that we do that in the UK compared to what we might want to do for instance, in South Africa or Kenya and so on. The conditions are very different, and this needs to be considered also in a discussion about climate finance. I will talk more about that in a bit. And the third reason why I think that climate justice is important is because right now we have a lot of initiatives from IMF or a little bit from World Bank about how countries that are climate vulnerable can finance spending related with climate. Now, the spending expenditures that are related with climate include spending about climate adaptation, projects that allow us to protect from floods, from droughts, and so on. But it also includes financial losses related with what we call damages, climate damages. And I suppose you are familiar with the fact that in the recent COP27, there was a very intense discussion about the fact that many countries don't have the financial capacity to cover climate damages and losses. And we are now seeing this broad policy debate about how this can be addressed. Now, the initiatives that we have seen, for instance, from the IMF are interesting in my view, but they do not put climate justice at their core. And I will explain later why this is a problem, because my view is that we are trying to do some very trivial things while the problem is much bigger. So this is a quick overview of the three reasons why I think that we need to focus more on climate justice. And now, my suggestion in this paper is that basically we need to incorporate climate justice perspectives into climate finance. And I use this term in order to describe a financial system that incorporates climate justice. So I call it a climate just financial system. In the sense, and this has two parts basically. Well, the first part is about how we take into account climate justice when we develop policies about the financing of climate spending. And this refers to both private and public institutions. But at the same time, this concept captures the fact that whenever we decide about how we allocate resources and how we finance these different types of climate spending, we need to take into account a principle that relies on United Nations, and this is a principle of common but differentiated responsibilities and respective capabilities. So this is a principle that goes back to 1992. So it has been accepted in the global community. But what I argue is that we need to incorporate this explicitly into climate finance as well. The components of what I call a climate just financial system are basically three. And the first one is about these differentiated climate responsibilities. So in the case of climate change, we have very often this distinction between climate mitigation and climate adaptation. Climate mitigation refers to any type of action or policy that has as a aim to reduce emissions. Climate adaptation, as I mentioned briefly before, refers to any kind of project or investment or spending that tries to protect people from the effects of climate change. So when we build some flood defenses, for instance, we try to protect properties and people from floods or other climate-related events. And what is crucial is that if we accept these differentiated climate responsibilities for different countries, then it's very clear that climate mitigation is primarily a responsibility for high-income countries. Climate adaptation is a key issue for countries that are more vulnerable to climate change. Let me also highlight that when I use the terms global north and global south, basically global north refers to the so-called Annex II countries according to United Nations, while global south refers to non-Annex I countries according to the United Nations Convention framework. Because sometimes it's not very clear which are the countries that we refer to, but this is what I have in my mind. Second, the climate just financial system also refers to how we can create what I call a climate justice stabilizing mechanisms. So the problem that we have right now is that in the coming years, we are going to see much more climate damages because global warming will continue to increase, unfortunately. And the challenge is that we don't have a specific mechanism that makes sure that financing is available whenever we have some climate-related events. And the other problem is that we don't have any mechanism to ensure that countries can spend on climate adaptation. And what I'm going to suggest, and I will explain later my proposals, is that we have to develop some stabilizing mechanisms that go beyond the current way of thinking about development finance. And the third aspect of a climate just financial system basically refers to the way that we define climate performance, in particular in the global north, because we know that there are many companies in the global north that try to achieve their emissions targets basically by exploiting people in the global south. And I will explain later what I mean by that. But I think it's another reality that we cannot ignore in climate finance, and I will also refer specifically to the European Central Bank about that. So let me first, this is the outline of my presentation. Let me first explain a little bit more why I think that there's a risk that the current initiatives in climate finance can reinforce global injustice. So I will refer to three specific channels about that. Then I will provide some more details about the elements of what I call a climate just financial system that I mentioned before. And after this, I will very briefly highlight some political economy and also some technical barriers to the development of a climate just financial system. And at the end, I will also explain what, in my view, could be an interesting direction in terms of research and also in terms of policy making in this area. So let me start by referring to this channel that I call exposing by self-protecting. So this channel has to do specifically with the way that financial institutions in general try to protect themselves from the effects of climate change. And let me give you some background on that. When we are talking about climate change and financial stability, we make a distinction between two types of climate-related risks. We have the so-called physical risks and the so-called transition risks. These risks are well recognized by all central banks around the world, basically. I mean, we have seen so many reports about these two types of risks. The transition risks refer to the implications for the financial system if we have a transition to a low carbon economy that takes place very quickly and in a way that it is not well designed. To give you an example, right now in the European Union, we have this carbon adjustment border mechanism, the so-called CBAM, which refers to this idea that there will be an increase in carbon prices in Europe, but at the same time there will be an increase in the cost of imports that come from countries that have carbon-intensive activities. And there is a concern that this might be good from the perspective of reducing emissions. This is a kind of transition policy. However, this transition policy can have some negative side effects on countries, developing countries, on emerging market economies that export carbon-intensive goods to Europe. This is a transition risk because if this happens, some companies in the global south might be affected financially from that. And then there's a concern that any type of climate policy, because it might lead to a reduction in the financial income of many companies that are carbon intensive, this can have some negative effects on the banking system as well, because some companies might need to pay high carbon taxes, and as a result, they might not be able to repay their debt. These are the transition risks. The other type of climate-related risks are the so-called physical risks. And this is the risk that I'm going to focus on right now. The physical risks refer to the fact that if there is any climate-related event that affects properties, destroys infrastructure, leads to lower agricultural productivity, all these events can affect the ability of people and firms to repay debt. And this can lead to a kind of a banking crisis at some point, because if there is, for instance, a cyclone or a hurricane and there are significant losses in the real economy, these losses will translate into financial losses for the banking sector as well. Now, what is the challenge that we have here? On the one hand, from a financial risk perspective, institutions have to take measures in order to protect themselves from the exposure to these types of risks, right? I mean, if we have that, for instance, there is a bank that is very likely to face debt defaults because it has provided loans to companies that are in very climate vulnerable areas. Someone could say that they have to do something in order to reduce their exposure to this risk. And one way to do that would be, for instance, to stop providing lending to these companies. The problem is that if all banks start doing something like that, those companies or households that are exposed to climate risks might see an increase in the interest rate that they have to pay and might lose access to the financial system. And this means that it will be more difficult for them, for instance, to invest in climate adaptation. It will be more difficult for them to get access to finance if they see some damages in their properties. Now, if we look at the country level, the other risk that we have is that if all financial actors around the world start incorporating physical risks into their credit risk models, it is very likely that there will be a reduction in investment related to the government bonds of climate vulnerable countries. And this is a challenge that we are facing because this is coming. I mean, if you discuss with credit rating agencies, as I mentioned before, they are now trying to analyze these physical risks, and they are going to downgrade countries because they are exposed to climate-related events. This is something that has been highlighted in the academic literature, and Victor has also written a couple of papers about that, and I would like to explain a little bit the problem that we have exactly with this increase in the cost of borrowing. So if we have, for instance, that some credit rating agencies downgrade countries, that have not only high public debt, but also have this problem with the exposure to climate-related events, the cost of borrowing will go up. And then it will be difficult not only to get access to finance in the traditional way, but also to have finance in order to invest in climate adaptation. So if there is less investment in climate adaptation, then the vulnerability to climate increases even more. And then we have the credit rating agency, which says that now the country is more vulnerable to climate change, and then the cost of borrowing increases even more. And this creates this vicious cycle, which affects not only the public debt and the cost of borrowing for the public sector, but we also know that this will affect the ratings for private companies as well. So this can create a quite significant problem in practice if we don't do anything in order to change that. This was the first channel. The second channel, whereby some climate finance initiatives might exacerbate global injustice, is what I call decarbonizing by exploiting. What do I mean by that? We have in many cases, right now, there is a lot of pressure on companies in Europe and the UK to decarbonize their operations. So basically, they need to reduce their emissions as quickly as possible. There are many companies that have some ambitious targets about reducing their emissions. And on top of that, what we have with the financial system is that central banks now try to create more pressure on financial institutions to decarbonize their portfolios. One of the reasons why they ask them to do so is because it is considered much less risky to have low emissions compared to having high emissions. This is related to the transition risk that I mentioned before. And the ECB, for instance, has started a process as part of their financial supervision activities, whereby they ask commercial banks to identify how they will reduce their exposure to transition risks. And when banks have to do that, it means that they also ask from their clients, their borrowers, to make more efforts in order to reduce their emissions. And all this sounds good, I suppose. I mean, it's good, of course, for companies to start reducing their emissions and reduce their exposure to transition risks. The problem, however, is how exactly companies try to do that. And there are two aspects specifically. I have two examples here, which I think might be problematic. The first one, let me start with the carbon offsets. So the targets that the companies set refer to what we call net emissions. So they have to reduce their absolute emissions, but if it is not possible to reduce their absolute emissions, they can also buy some carbon offsets, whereby they pay money in order for someone else around the world to reduce their own emissions. Okay, this is the idea behind carbon offsets. So for instance, when we travel, there's sometimes the option of buying some carbon offsets, and the idea is that we pay for a specific reduction in emissions. Now, the challenge for many companies is that it's very difficult to reduce their emissions very quickly, and many of them are relying quite a lot on carbon offsets. Some of the carbon offsets are credible and can do their work without creating problems, but a significant proportion of carbon offsets at the end of the day are related with projects in the global south, where the idea is basically to protect some forests and not allow the local population to use forests or land or any other aspect of the natural environment that is important for their daily life, but from the perspective of climate change needs to be protected. And what we have seen is that in many cases this has been done in a way that doesn't take into account the needs of the local population. And my concern is that there will be a very high need for carbon offsets in the coming years because of this pressure to decarbonize the activities of non-financial corporations in the global north. And it is very likely that not enough attention will be paid to the needs of local communities. The other concern that is discussed now quite a lot is related with the so-called green materials. And green materials are important. I'm referring, for instance, to copper or lithium, because, of course, they are very important for batteries and in general, for low carbon technologies. Now, on the one hand, the fact that there is a high demand for green minerals is good for some countries, I mean, that have these minerals, because it means that they can export more. But there's also a problem in the sense that this creates more appetite for companies in the global north to try to exploit some of these materials in the global south, in the sense that they do not always pay attention to how they are going to do that in a way that is good for the local community. And in many cases, the way that mining takes place has negative effects for the local ecosystems. And as I said, the concern is that because of this pressure to have this decarbonization quickly, not enough attention will be paid to the needs of people in the global south. So we need to decarbonize, but not by exploiting communities in the global south. And I will explain later how this can be addressed, perhaps. And the final channel that I would like to briefly mention is related with what has been recently called the Wall Street Consensus. The Wall Street Consensus is considered to be a kind of the next step after the post-Washington Consensus in development finance. So what is more or less the idea behind this? I suppose you have seen many reports from IMF and World Bank that highlight that developing countries don't have the fiscal space to spend money on climate change. And because of that, the approach that is promoted is basically for governments in developing countries to provide incentives to private investors to go and invest in specific projects. And in many cases, I mean, the term that is used for that is de-risking, in the sense that governments need to provide some guarantees to private investors. They need to provide some subsidies in some cases. They need to adjust some regulations in order to make it possible for these investments to happen, and basically to reduce the risk of these investments. And I mean, in principle, someone could say that this is not necessarily a bad idea. I mean, if the financial resources are not sufficient for a specific country, it's not a bad idea perhaps to ask for financial institutions to contribute to that. The problem is that in practice, what we have seen over the last 5-6 years is that we haven't seen any significant increase in investments related with this approach. But most crucially, there's a very significant risk that because governments provide a lot of guarantees, in the case in which the projects don't go well, this after a few years can lead to an increase in the liabilities of the government, in particular the contingent liabilities, and they can basically contribute to public debt without necessarily delivering. And the issue that I would like to highlight from a climate justice perspective is that if there is a need for a climate adaptation project in the global south, I mean, the reason why this is necessary is because many countries, many high-income countries, contributed to the climate crisis for so many decades. So the responsibility is to a great extent with the countries in the global north. Saying that the countries in the global south have basically to do everything in order to attract investors and give them a lot of space in order to do so doesn't take this into account. And in practice, what we have seen is that governments in the global south are asked to contribute quite a lot to the risks related with this investment. So I think this is also something that we have to reconsider. And I think this is now the right time, because it seems that the projects have not been very successful overall. And the needs that we are going to have in the coming years from a climate perspective are growing. So these were the three channels that I would like to highlight. And as I said before, I don't think that right now there is no one basically pays attention to these channels. But let me now try to explain how we can perhaps address these problems that I highlighted. And firstly, I would like to talk specifically about the different ways through which the financial system can address issues related with climate change. And in the policy, in the climate policy literature, we make this distinction between climate mitigation tools and climate adaptation tools. So I mentioned it briefly before, but let me now explain with a few more details. So generally speaking, a climate mitigation tool refers to a policy that in the context of the financial system tries to reduce the cost of borrowing for green activities and perhaps try to make it more difficult for dirty activities to be financed. So, for instance, if the European Central Bank has recently decided to buy more corporate bonds from non-financial institutions that are green or have reduced their emissions much more quickly than other non-financial corporations. Now, by doing so, they basically increase the demand for their bonds, and this can reduce the cost of borrowing for these companies. Another example is, for instance, what Bangladesh Bank did many years ago when they decided that they would ask the private banking sector to provide a specific proportion of their loans to green activities. It was initially 5%, and then they increased that. This is a kind of a green credit guidance policy. I mean, we can talk about the advantages and disadvantages of doing so, but this is another way through which we have seen the support of green activities in the case of finance. And another example that I mentioned briefly before is what the People's Bank of China has done. Basically, they accept in a more, I mean, they provide a better treatment of green bonds in their collateral framework, which means that there's an incentive for banks to buy green bonds and financial institutions to buy green bonds because they can use this in order to get access to central bank liquidity. Climate adaptation tools have not been used very explicitly in climate finance so far, but of course, in general, climate adaptation is very important because it's about protecting people from climate change. Unfortunately, climate change is going to become worse, and we know that we need to spend more money on climate adaptation. Now, the question is how finance can support climate adaptation, and it can support climate adaptation if we find ways, for instance, to provide lower interest rate loans to those who need to make investment in order to protect themselves from climate change. There are cases, for instance, in which microfinance institutions have been used in order to support people who don't have access to formal credit, and any type of financial initiative that can support communities and corporations that suffer from climate change is considered to be a climate adaptation tool. Why do I make this distinction between these two tools? Because I want to highlight the differences between countries. So let me first summarize the different tools that can be used in practice. So I have already mentioned asset purchases. I have mentioned collateral frameworks. Let me say that collateral frameworks are becoming more important around the world. I know that initially collateral frameworks were primarily developed by the European Central Bank, but for instance, now Southeast Asia has central banks use collateral frameworks quite a lot. And to give you an example, there is now a discussion about the so-called green sovereign bonds. So these are bonds that are issued by governments in order to support specific climate projects. And this can be climate mitigation or climate adaptation projects. The expectation is that there will be much more issuance of green sovereign bonds in the coming years. And in particular, Southeast Asia has a high interest in that right now. So if you have a collateral framework whereby central banks say that green sovereign bonds can be used as collateral at a lower haircut, it means that the demand for these bonds can be higher. So the idea here is to give a favorable treatment to green bonds compared to traditional bonds. Refinancing operations have been used by the Bank of Japan, and the idea is that the interest rate for commercial banks can be lower if they support the companies that need the banks and companies that make more efforts in order to reduce their emissions. And of course, there's a lot of discussion about development banks. And there are many development banks. I mean, in Europe, the European Investment Bank, for instance, has incorporated some climate criteria in the way that they provide loans. But many multilateral development banks, of course, the African Development Bank, I mean, there is now a lot of discussion about how green projects can be supported by them. So there are a lot of things that are happening and many new initiatives. And many of them target directly climate mitigation and climate adaptation. Some other of these initiatives refer to risks. But what I would like to highlight is that when we are talking about these types of policies, one size doesn't fit all. And we cannot just have that, some governments or financial regulators in developing countries just try to do what countries in the global north do. And I'm saying that because I have seen that in many cases when we have these discussions with people from IMF and World Bank, the idea is implicitly that, other countries or other financial institutions have to do more or less the same. And in my view, what is very important is to highlight that decarbonization can happen more easily in the global north, and it has to happen primarily there. But when, for instance, we are talking about how we classify climate-related activities in the global south, we need to highlight that the transition needs to be smoother and it will take more time. But at the same time, climate adaptation has to be supported. And climate adaptation is not only important in general about dealing with climate change, it's also important for financial stability. If we don't find a way to support climate adaptation, the financial system in many countries will become more fragile because of climate-related events. So it's very important to find a way to do that. And in my view, the national policies in countries in the global south have to focus more on that instead of asking them to do too much in the context of decarbonization. Now, the second element of what I call climate just financial system is related to what I call climate justice stabilizing mechanism. And I have to say that this proposal that I have here might be a little bit provocative, but let me provide some background behind it. So it has been recognized by the United Nations Framework Climate Change Convention that countries that belong to what is called Annex 2 need to provide financial assistance to non-Annex 1 countries. And this has been related with climate justice. Now, this was recognized in the early 1990s. And we are now in 2023, and the amount of climate finance is still below $100 billion, despite the fact that there was a target about achieving that much earlier. If you look at the climate finance needs, this amount is far below what is needed. So this hasn't worked. And on top of it, I have some data here about that. Most of climate finance, as you can see in this graph here, has to do with mitigation and not with adaptation. And it has been highlighted that this is a problem based on what I described before. But this is not my view. I mean, this is a view of most people who work on climate change. And the other problem is that most of this finance is in the form of loans. So here the public finance, the composition of public finance is basically 72% loans, 25% grants. And this is another problem because if we have too many loans that are provided to countries in order to support climate spending, I mean, this can increase their public debt. And we know that many of these countries are vulnerable to debt crisis. So it has been recognized that this is not enough. And despite the fact that there have been a lot of efforts in the different COPs over the last years to change this picture, the progress is very slow. So when we want to develop some other proposals to address this problem, I think it's very crucial to take into account that countries in the global north can spend much more easily compared to countries in the global south, We saw that very clearly with COVID-19. I mean, if we look at fiscal spending in the UK or US after the outbreak of the COVID-19 crisis, there was a huge increase in spending compared to what we saw in many other countries in the global south. And the reason for that is that there is a kind of hierarchy in the global financial architecture. I mean, US dollar is a global currency. It's not easy for governments in the global south to spend in the same way. And this becomes very important in the context of climate change, because now those that have to spend more are those who don't have the responsibility for the climate crisis. In the academic literature, these responsibilities of the global north have been summarized by using this concept of climate debt. And climate debt is related with what I mentioned before about cumulative carbon emissions. And we also have to consider, as I highlighted before as well, that if we look at projections from IPCC, climate losses and damages will increase in the coming years exponentially. And this is a significant problem because it means that spending will become much higher. I mean, perhaps it will become much higher forever, because even if we manage to be below 2 or 1.5 degrees, the climate damages will be much higher compared to what we have right now. So the global community in finance has recognized more or less this. And this is why now we have seen some recent proposals about having a debt relief when, for instance, there is a climate event. We have these proposals about debt for climate swaps. And the idea is that countries can see a reduction in their debt if they use the money that they save from the debt relief in order to invest in climate projects. We have seen some proposals about using differently special drawing rights and try to use some of this in order to invest in climate. And there are also some more radical proposals, let's say, about climate reparations, whereby countries in the global north basically compensate for climate damages in the global south. And I think all these proposals are interesting and they can be useful. And I think some of them at some point might be implemented. But I don't think that they can be enough in order to address the problem. And one of the issues is that the first two proposals, debt relief and the climate use of SDRs, I think do not recognize the issue of climate justice. In most cases, this is considered to be a kind of philanthropy from countries in the global north to the global south, that they will accept to provide some debt relief. It's not that it is recognized that, countries in the global north have the responsibility. And I mean, climate reparations can be useful. There can be a very big debate about them, but I don't think that they have the potential to support climate spending, given that climate spending is going to increase quite a lot in the coming years. So in my view, we need something more radical in the sense that we have a very significant challenge in front of us. And what I'm suggesting, and it's a proposal that is still very much in progress, is the creation of what I call a climate justice facility, which will basically have the responsibility to collect money from the global south and give this to from the global north and give this to the global south, but under very specific rules. And the rules related is particular to the fact that this facility is going to focus on financing climate spending. And in particular, this facility, according to my view, needs to focus on covering climate losses and damages. It can also cover climate adaptation, but losses and damages are very significant right now. And the idea is basically to recognize what I mentioned before about the existence of a climate debt. And then if we take this as a starting point, what I suggest is that this facility will provide some climate loans to global south governments, but these loans will be perpetual. And this is what is perhaps provocative, in the sense that it will not be necessary for these loans to be repaid. I mean, we have seen perpetual loans in many countries around the world in the past, but the idea is that these loans will not be repaid because of the climate responsibilities of the global north. Now, the climate justice facility will also try to collect money from the global north based on the cumulative emissions. So we have now the data in order to estimate the responsibilities of different countries. So we can do that. And there are many papers that have quantified these responsibilities. And the third aspect of this climate justice facility is basically to have an interest rate that is very low, not very far from zero, in order to avoid increasing the financial burden of global South countries. And I have here some balances where I saw how this can work. And I mean, it's very straightforward from a balanced perspective. I think the main challenge with this proposal is the political feasibility. But the idea is that we have this climate justice facility. Let's say that there is a climate event in Barbados, and it is necessary to spend some money in order to cover this the loss from this event. So basically, there will be a demand, an automatic demand, because the idea is that this will be in place from the government of Barbados to the climate justice facility, that they need a climate loan. Okay, so this will be on the liability side of the government, and they need to get money from that. And then climate justice facility goes basically to, I mean, it could be directly to the central banks or through another financial institution, but it basically goes to the different countries in the global north. We have, in principle, we have estimated the different responsibilities and asked them to basically provide these loans as they have done in the past when they, for instance, implemented key programs. So they are going to create money to provide these loans, and this will be on the liability side of the central banks. The climate loan will be on the asset side. And the purpose of the facility is to collect all these loans and to provide this to the government of Barbados. So, as I said, in theory, it is straightforward. Of course, there are many practical implications if we try to implement that. But it's something that we see quite a lot in the global north. I mean, over the last 15 years or so, basically, central banks have created money to support the economy. The problem is that this is not the case for countries in the global south. So I can get back to that, of course, in the Q&A. What I would like to highlight is that this facility can be a complementary tool, of course. I'm not saying that all the other initiatives are not important. I'm just saying that they might not be sufficient because of the climate emergency. I think it's also important to have this facility because otherwise, private financial institutions, I think, are getting a lot of power, and I don't think that it's good to have financial institutions that have a lot of power. We need to distribute power in a more equal way, and they have now a lot of power in the context of climate change because many companies, I mean BlackRock, JP Morgan want to go to the global south, invest in climate projects, but they do that in a way that I don't think is always beneficial for local communities. So having a facility that can address automatically some of the problems, I think would be useful. And I think would also be useful for credit rating agencies. I mean, the problems with credit rating agencies, because if a credit rating agency knows that there will be some financial support, it is less likely to downgrade the country. Because what credit rating agencies look at is basically the climate vulnerability. And vulnerability depends not only on the exposure, but also on the investment that is made in order to reduce the vulnerability. So I think this can be beneficial also for this, which means that, if you put in place something like that, you can also reduce the risks overall, and it might not be necessary to always use this facility. It's very important to have something in place in order to create some incentives in the private sector and to avoid a crisis. So I know that I don't have so much time. I have already used most of my time, but let me turn to the final element very quickly, and then I will try to conclude. So the last issue that I would like to highlight is that, as I said before, we have seen cases in which many companies around the world basically use the fact that they want to decarbonize their activities in order to justify some controversial activities that they are necessary in order for them to reduce their emissions. And let me refer in particular to what is happening right now with the ECB corporate bond purchases. The ECB has decided to, as I said before, to support more companies that reduce their emissions. But the problem is that they don't look at how companies reduce their emissions. They just look at the data about emissions. They don't know what is happening behind them. And I'm now looking with one of my students at what is happening with respect to some companies that are in the QE program. And there are many cases in which companies that do things that are good for the environment in principle have been engaged with controversial activities in the global south. There is an environmental justice atlas, for instance, that summarizes these problems. And my suggestion is that these types of activities need to be considered, and support from central banks and financial supervisors should be conditional to the lack of these practices. Because otherwise we create an incentive to firms to basically do more of that. So if we start collecting data about carbon offsets and how specifically companies try to reduce their emissions, I think can be another criterion that can be incorporated into these programs. And I know that this might be difficult to happen in practice, but for me, it's very significant not to have this type of exploitation. So I made a lot of suggestions, and I'm sure that you will have a lot of comments on this. But of course, I know that many of them cannot be easily implemented. One reason is that, for instance, supporting countries in the global south might not be very popular in people in the global north. There are also problems related with the mandates of central banks. I mean, the mandates have to be adjusted a bit. And let me give you an example. In the case of the ECB, there is a distinction between the primary and the secondary mandate. The primary mandate is, of course, inflation targeting. The secondary mandate is basically to support the European policies. And based on this secondary mandate, the ECB has argued that they want to support climate finance because they need to be in line with their secondary mandate. So the secondary mandates in many cases have to be adjusted, which means that first governments need to make a commitment to climate justice. It's also an issue that these proposals might not have the support of some private financial institutions, and but my view is that based on what happened in the last COP in Egypt, in COP27, I think there will be a much higher demand from global south to global north in terms of having support for losses and damages. And I think that the policy discussion might change in the coming years. There are also some technical issues, and this is related with what I would like to suggest for future research. I mean, it's very important to find ways to have criteria about which projects can be considered as climate adaptation projects. There has been progress on that. Happy to talk more about that in the Q&A. It's very important also to deal with technical details about climate loans. I mean, we have a lot of experience from green bonds, and we can draw on that experience. And we also need to collect more data about carbon offsets and so on. We don't have in most cases this data right now. But just to conclude, my view by being part of many of the discussions about climate finance is that it is important to introduce this justice perspective. If we think that this is important, I think there are ways to think about the political barriers, and there are also ways to try to do research in order to support this direction. Thank you so much for your attention, and I very much look forward to your comments.
Thank you very much, Yannis. A great paper and very well presented, very clearly presented. These are indeed important issues, as you emphasized throughout your presentation. They are also global issues in the sense that concerns of global north and concerns of the plight of the global south. You also, interestingly, covered a lot of examples, feasible solutions, and even provided areas for further research. But before I give any detailed comment on this, let me take this opportunity to invite a views from the world of policy and practice, and have great pleasure to invite our colleagues Jonathan and Oswald from the Central Bank of Zambia, are great friends of the Center for Global Finance at SOAS, and also very active in the African Economic Research Consortium think tank. So Oswald and Jonathan, please go ahead and share with us your discussion of the paper.
Thank you so much, Professor Victor, and also would like to thank the presenter, Yannis, for this illuminating paper. And this paper has overall highlighted the debate on climate justices or injustices that are prevalent in our environment. Just to put some disclaimer to my discussions, this presentation is made by myself as a member of staff of the Bank of Zambia in my individual capacity. Its contents do not present the official position of the Bank of Zambia. So I'll be discussing the paper based on my interaction within this area, and also what I've been doing as an employee of the Bank of Zambia. So the bank is very active in the area of green finance. These aspects that Yannis is raising, dealing with injustices in climate finance, part of the our regulatory mandate under the Alliance for Financial Inclusion. Under the Alliance for Financial Inclusion, the Bank of Zambia is involved in inclusive green finance. So what inclusive green finance implies is that we are taking on board all matters to do with these injustices and try and include them in our regulations. And this also is anchored on the national development commitments. So we base our activities on the national development commitments under the Ministry of Green Economy and Environment. So they drive the policy, and then as a bank, we support that policy. So in a nutshell, in terms of how I'm going to deliberate on this paper, that will be within those lines that I've outlined. So the outline of my presentation is as follows. I'll begin with the introduction, then move on to look at issues to do with global injustice, or how climate finance exacerbate global injustice. Then I'll look at the climate just financial system, the key elements as presented, and then I'll move on to comment on a just financial system, whether it's politically or technically feasible, and then I'll conclude. So beginning with the introduction. So from the paper, I will start by introducing probably the climate science. so that we can put things into perspective. And then after that, I'll move into providing some detailed comments. So from the climate science, we know that there is a linkage between atmospheric carbon dioxide with the temperature. So this is the basis of the discussion. So there is a positive correlation between the CO2 concentration and the Antarctic temperature. This is one of the outcomes of the empirics that has been presented by our colleagues from the global north who have been doing studies on this. So this can be extended to other jurisdictions or other continents. So we know that there's a positive correlation. So the higher the CO2 concentration means that the temperature will be high. And this is the major concern, which is also driving climate change issues, such as droughts in some parts of the world. So carbon dioxide is one of the sources of greenhouse gases, and it's a major focus of the discussion as follows. You can see that from the riding on the studies from our colleagues, other jurisdictions, you can see that you have the greenhouse gas emissions. It's not only carbon dioxide, but you have methane is also released into the atmosphere, nitrous oxide, especially from the manufacturing activities. Agricultural soil management also releases nitrous oxide. Then you have hydrofluoric bonds, also emanating from maybe semiconductor manufacturing, and so on and so forth. So you can see that globally, a number of economic activities generate, these greenhouse gas emissions. Now, in terms of
it appears. Okay, all right. Yeah, go ahead. Yeah.
Yeah. So we have the a few results in terms of the AR6 2021 reports, which also give us the results about global warming and trying to give us where we are at. We're at 1.1 degrees, which is between 0.8 and 1.2, and we are warming at just over 0.2 degrees per decade. So by 2040, it means that we shall be around 1.5 degrees warmer, and therefore still geophysical possibility to limit warming. We have to limit warming to 1.5 degrees globally. So the difference between 1.5 and 2 degrees is worth avoiding. So because if we don't, on a global scale, if we don't limit the emissions, we might be able to reach 2 degrees, which we need to avoid. So climate change effects, based on the data that is there. So we can say that from the Zambian perspective, we are experiencing climate change-related droughts, floods, and extreme temperatures. We also have economic system practices such as charcoal burning, mining, agriculture, construction, among others. And these are depleting forests, carbon absorption capacity, contributing to climate change effects. We also know that from the statistics that Africa only contributes only 4% of the greenhouse gases to the total global greenhouse accumulation. So we can see that Africa is basically a decarbonization agent, because we only contribute about 4%. And just a deep dive into sub-Saharan African countries, you can see that it hasn't been possible to decarbonize poverty and inequality. Because you see that these markets, these global markets, are not developed to take advantage of the space that we have in terms of absorbing carbon, because the industrialized North, or the global North as they are called, can then develop these markets into Africa. But it's like the market is not very active, as I will later on refer to that. So Africa has the potential to decarbonize the global CO2 concentration, and Africa has not been able to take advantage of that space. So we can see that from the picture here. We can see some of the activities in terms of carbon capture and storage. We have lakes and rivers, and then we have we also have forestation and land where carbon can be stored. And the other issue is about urbanization. If you look at statistics from our colleagues from the University of Cambridge, you see that urbanization in the US and Europe, they're about 423 million over 200 years. But for Latin America, Asia, and Africa, you have 3.9 billion people in 8 years. So you can see the graphs, the peaks, or the steepness of these graphs, and this creates some potential issues or problems regarding carbon emissions. You can also see further illustrations in terms of what is happening on the global scale. The top graph is talking about the linear metabolism. Cities consume resources and create waste and pollution at a higher rate. And then the bottom graph there is looking at the circulation metabolism. Cities reducing consumption, pollution, recycle, and maximize renewables. So you can see that the North is polluting, and then you can see that the South has the potential to absorb the pollution. So now let me dive into the issues that have been raised in the report or in the paper. The first thing that I want to talk about is how does climate finance exacerbate global injustice, and make my comments regarding that. Okay, so first of all, I definitely agree. We agree that we need climate just financial system. I think it's a good idea to have a climate just system, and inclusive green finance is one of the options through which we can achieve that. Okay. So we are told that this is a system that has two basic features, and we do agree that these are from the assumptions given. We have the public and private financial institutions that incorporate climate justice criteria into their policies. So this is happening in most central banks around the world, in many jurisdictions. that they're trying to incorporate climate justice criteria. And then secondly, the financing of private and public climate spending is also in line with the principle of common but differentiated responsibilities and respective capabilities. So this implies that the issue of proportionality in the way regulations are applied becomes very, very important, because you can't treat all the institutions on the same level. Now, regarding the climate injustice, we also are agreeable that there's some level of injustice going on, especially exposing by self-protecting. The global North institutions are exposing by self-protecting, meaning that they're increasing the exposures to physical risks of banks in the global South by those in the global North. So what they are doing is that they are shifting risks to the global South. Now, the problem with this is that it's very difficult to pin down this injustice. It will be difficult to target regulation to those practicing exposing by self-protection, because this is a market-driven. This is how the markets are operating. These are private institutions, and they are profit motivated. Then, whereas the third one, the decarbonization by exploitation, which we agree that this also relies on the green extractivism and carbon colonization. This one, this can easily be regulated, as I have alluded to, and our collaborative efforts. We are looking at integrating, for instance, this can be done by integrating environmental, social, and governance, considerations into regulations, such as the green loans regulations could be an avenue through which you integrate ESG. And if you integrate ESGs, then you be curbing decarbonization by exploitation, meaning that those companies that will be involved in, for instance, in social injustices, of course, then in terms of access to cheaper loans, that will be very difficult for them to do that, to access financing. And then for the first one, the Wall Street consensus, basically, we do agree that it's about the exploitation of the global South banks by global North private banks for profitable motives. Of course, this is a business arrangement, and the key issue here is de-risking through green credit guarantee schemes, which is possible to focus resources towards climate-aligned development. So meaning that the first and the third one, the third basic features, it's very possible to incorporate them into regulation and try to minimize those kind of injustices. But the second one becomes very elusive in terms of how you can actually cramp it and then deal with it. So I've tried to provide some other sources of reading on global injustices. So I will share the presentation, and participants will be able to go through some of those other key readings on that. The next comment is on the climate just financial system, the key elements. Now here, the paper talks about differentiated climate responsibilities for global North and South financial institutions, with the latter focusing on the focusing primarily on climate adaptation and the former on climate mitigation. Yeah, this is we definitely agree to that, that for a just financial system, there has to be that separation. The South should focus on adaptation, whilst the North should focus on mitigation. But there's also the third element of making the South more resilient to climate change. So resiliency should be also added to the global South, because we have to be resilient. Then secondly, climate justice, stabilizing mechanism that would commit global North countries to provide on a permanent basis climate financing support to global South without making the latter more financially fragile. This we definitely agree, and this can easily be minimized using green finance regulations by the central banks, and also de-risking some of these high-risk sectors through, of course, things such as the tools such as the credit guarantee schemes. And thirdly, incorporation of climate justice criteria in the design and the use of climate mitigation tools by the global North financial institutions. Of course, there are political issues regarding that, but of course, that's something that will have to be fought politically. It may not be popular in the global North. In terms of the global South, the global South, what is happening right now is that they continue to have challenges in accessing climate funds. So probably this aspect should also be reflected in the paper. Now, in summary, you find that the approvals are made, but funds take too long to be released for applicants from the global South. This has been evidenced from whichever institutions that you talk to that are involved in sourcing financing from the climate finance or the global climate funds. Then the portfolio values requires co-financing before approval is granted. So that's another aspect. So the question is, where do they get the money from to co-finance? They are applying for loans or grants, but they're being asked to co-finance. So this is an example of an onerous kind of application. There is no proportionality involved. So they are treating everyone, even the smallest, the same as the big guys who want to access these funds. So you find that the small guys will not even access the funds. Then secondly, the global climate funds instruments include grants and loans and equity. So this is one of the features and there are different types of grants and loans and equity. And thirdly, we also know that the investment criteria for a global climate fund is onerous and specific to national priorities towards low emissions. That is the mitigation and also climate resilience adaptation. So to access the funds, meaning that you either have to be involved in mitigation or you have to be involved in adaptation, and that's it. So those are some of the challenges. So what is the climate finance landscape like? Public finance, firstly, public finance that support private investment and private sector include, we have the Green Climate Fund, the EU Bank, the World Bank, GIZ, CIF, EU, IFC, FDB, AIB, CDC, and the GF, etc. So these are the funds that they are being tapped into by the global south. Then we also have the private sector interested in climate finance. These include the Deutsche Bundesbank, Schroders, and HSBC, etc. These are some of the leading institutions, private sector institutions interested in providing climate finance. And thirdly, we have the accelerators funding vehicles for innovations, and these include global innovation funds, adaptation funds, RF, AFDB, accelerator fund, craft, etc. So there are also this category of green financing. So you can see that the climate finance landscape is wide, but the only challenge there is the speed at which funds are being displaced from these funds by those from the south. Now, let me turn to the proposal of the Climate Justice Facility. The paper proposes to have the Climate Justice Facility, or CGF. Now, this facility, the paper says that it's low interest perpetual loans by industrial growth, global north to the developing global south. And its main feature is money creation implication on monetary policy. So the comment here is that it's not only the money creation that takes place in the global north, but there are also money creation implications on our monetary policies in the global south, because you are talking about disbursements now to the individual green projects. Now, these green projects may be run by the private sector, not necessarily government. So you find that funds will end up in the commercial banks, and that will have monetary policy implications in terms of money creation in the global south. So the paper has to also maybe speak about that in terms of how money creation implication will be like in the global south. Then secondly, we have a question of how different will the CGF be from other existing green financing mechanisms that have embedded ESG principles, green loan and green bonds principles, and sustainability loan principles. So we are saying that we have already existing instruments that have incorporated these principles that go towards creating a just financial system. So the question is, how different will the CGF be from what is already existing? Probably that should also be strengthened in the paper, because probably they are not specifically talking about the just financial system, but implicitly in them is a just financial system. Thirdly, what is the CGF framework and what is the architecture? This is another thing that needs to be looked at. If the proposed CGF will be very, very operational and very attractive. How do we ensure effective implementation of the global level, at the global level? I see it's central bank to central bank, but I think the issue is that of of coordination of these dates, because these are dates that will be incurred by the respective central banks or governments through central banks and then to commercial banks. So how does the CGF, fourthly, how does the CGF intend to solve the dilemma of borrowing in the foreign denominated currencies? Because this is a major problem in the global south, that every time we go into the debt market, our debt is foreign denominated. We are not allowed to borrow in our own currencies, and this is a major problem. So how if the CGF can try to solve that dilemma, then it will be very good. And how do we maintain low indebtedness and liquidity in our institutions in the global south, given that the CGF will be at low interest and these are perpetual loans? Okay, then finally, I think our last comment is on the climate just financial system. Is it politically or technically viable? So our comment is that the CGF seems more attractive to the global south than the global north, who control the financing. So the question is how the receipts of the CGFs into public accounts in central banks ensure that funds reach projects in quick time. Maybe there is a need for global standards to guide the usage of such funds. Are we going to have global standards under the CGF? Is that something that you can also look into, just in terms of coordination and adaptation? Then secondly, CGFs could be accessed by commercial banks and not governments to enhance usage to targeted green projects. The paper may need to take this into account, and also a private sector driven initiative enhances efficiency in resource allocation. So you've taken a public sector approach. Most of our economies in the global south are market driven, and I think interest should be in the private sector. Funds should ultimately be targeted at the private sector, who are the ultimate users of adaptation funds. Let them go into adaptation projects, as opposed to governments going to adaptation projects, because of the problem with the debt trap, public debt trap. So if it's private driven, that's the best for us. Okay, next is that the CGF would make the global south more regulatory and price attractive than the north. And we know that due to globalization, how would the CGF control for regulatory and price arbitrage between the north and the south? Okay, given the high level of globalization of banking businesses, such as ownership, you find that the owner of a bank in the global south is the owner of the bank in the global north. So there will be that cannibalization of businesses in the north and opting to go in the south, where it will be cheaper to borrow. And then funds will be finding themselves in the global north. These are realities of how these businesses operate. So they want to maximize their profits by minimizing their costs. The next, but not the least, is that the CGFs are technically unfeasible, but these are politically infeasible from a point of view, especially from the global north perspective. So then how will the CGFs create acceptability from our colleagues in the global north? Because they are the ones who control the finance space, and they are the ones who be releasing the funds to the global north. So how will that play out? Okay, so that's now in conclusion. So we would like to say that the CGFs are politically feasible in the global south. So we do agree that it will be very attractive for governments, the way it has been proposed to borrow at lower rates and perpetually. But asking the private sector in the global north to share the cake equitably with the global south is a tall order. There will be conflicts involved. So what is the economics of conflicts here? So we need to dive into that, the economics of that conflict, of equitably sharing the cake. If the global standards are adopted, the global north private sector are likely to have low compliance levels. This would mean lowering their profits. And then governments in the global north will become less popular if CGF standards are mandatory. We expect conflicts between private sector and governments, and this is a possibility, just a possibility. We are not saying it will be there, but it is a possibility if these standards were mandatory. If they were not, then we'll come back to the status quo. Finally, what we can say is that the Global North Central Bank should help develop global climate and sustainability finance guidelines driven by a private sector incentive system to reduce the climate injustice finance. I end my presentation. Thank you.
Oh, thank you so much, Oswald. Really, very high quality, very pertinent. I think you and Yannis all together, when I come, you bring the initial work and the comments that raises the whole discussion to another level. I knew we were running out of time, but the points were so spot on that I couldn't but even think of stopping you in a time. Your comments add great value to the paper. Insight observation that could only come from a good researcher as well as practitioners, some of the issues. So, thank you indeed. And I hope that you can share the discussion with us, the PowerPoints. We can share this with our audience in due course. But there are quite a number of things that come out both in Yannis's paper and the discussion by Oswald and the group at BOZ. I'm not going to kind of provide a summary as such. I just want to pick on some of the key issues. The issue of potential trade-offs actually comes out very strongly. To the central bank is that they have, the mandate of protecting price stability, that is inflation, regulation for financial stability, and smooth balance of payments system. Now, is the climate just financial system a consistent with that? I think this is where research can. Is it at variance? If there is a trade-off, or it is possible to achieve both the mandate and climate just financial system at the same time. That's for the central banker. For the Minister of Finance in the economy, they will be thinking, okay, we have to deliver growth. We have to achieve a reduction in poverty and reduction in inequality. Now, is the system, a climate just system, at variance? Is there a trade-off? And maybe research, say experimentation can show that maybe you can actually achieve both at the same time. I love the idea of the climate justice facility and the critique that Oswald provided. I think it goes back to the 1992 Rio Declaration of this polluter pays principle. Saying that those countries should be able to bear it. So that's absolutely rating important. And finally, the rating agencies. I think we need to revisit the role of the rating agencies, because in many ways, the way it would work is you have a climate risk catastrophe happening in country X at time T. At time T plus one, the macroeconomic indicators go berserk. They just completely. And then these are the input into the rating, any rating model. So it's very difficult actually to kind of address it unless you remove the rating agencies from the issues of bonds. But if they have to do the rating, they will inevitably have to create that risk premium. And the vulnerable 20 experience, I think in our paper that Yannis mentioned, we compute that for every $10 in debt repayments, one additional dollar goes into that formula because of climate risk. Let me open this discussion to the floor. Just please put up your hand and go straight to the question, because we are running out of time. The discussion has been rich both from the presenter and the discussant, but would like to have observations, quick observations. Oh, let me see in the chat. Maybe, okay. So Kemi first, please go ahead. Kemi is our professor of accounting in the SOAS. Please go ahead.
Thank you very much, Yannis and Oswald, for that lovely presentation. I just wanted to know if you have considered the role of accountability, the role of sustainability report, ESG sustainability reporting in this, because, as you will be aware, there has been a lot of regulations to regulate climate related disclosures, like the Sustainable Finance Disclosure Regulation that was issued by the European Commission, and the IFRS that recently established a board just to introduce standards, sustainability standards to guide the disclosure of this information. And also, we do know that the G7 also, launched the task force on nature-related financial disclosure. So I was just wondering, looking at it from my discipline, that's accounting, what you think the role of this report, the accountability for these issues can be in what you are doing. Thank you.
Yeah, thanks indeed, Kemi, for bringing that strand of literature, very important literature on SG accounting. Let me take a couple of questions in the interest of time. A second, Professor Slight at Makerere University Business School, please go ahead. And then third, we call upon Simpasa.
Good evening to everybody.
Good evening.
I hope I'm heard very good. Now, thank you so much, the presenters. This issue of climate change is very, very pertinent. And I am going to focus more on the presentation made by Yannis. Yannis, Dafermos. And I know this could be a desk paper where you have done maybe literature review. Am I right? It is more to do with the review of several papers. Maybe in order for the readers and the listeners and those who are viewing the slide to be very, very, very well catchy, we normally use what we call a matrix. A matrix would help us to see what has been done previously, so that we see what are the gaps. So when we see the matrix, we look at author, like how you mentioned the paper by Professor Murinde. This is what we studied. This is what he came up about. This was his suggestions. Then in that kind of, depending on how you are, whether it is systematic literature review or whatever case you are using, then when we look at that kind of systematic literature review, then we are able to see the trend and where it is. So that by the end of the day, we can know the interventions and on whom the interventions can be done. Like in this case, I wanted to ask, with this issue of climate change, who should play the biggest role? There is the Bank of Zambia, for example. Should this role be done by the banks, like what you said, what's happening in the Bank of Japan? In the banks of Japan, or Japan is saying, for us, we are not going to finance any company that is not actually accommodating climate change. So when we get such kind of reviews, then we can, by the end of the day, say, based on the several papers I have reviewed, this is my conclusion. We can combat climate change by one, telling commercial banks, and the government, the central banks can instruct commercial banks by saying, any bank you are going to finance that does not have climate change factor or expenses to control them, do not give them any loan. So that now, but all that will be stemming from your systematic literature review of the papers in a certain order, based on what all of them have come up. Your conclusion should have told us what needs to be done. How do you conclude? Now, because we lack that systematic literature review, because there was lack of that matrix of the several papers and what they came up with, somewhere, somehow, when we shifted to the person of Oswald, we somehow got lost, because I thought it was a continuous from that matrix to his presentation, but somehow, somewhere, we went into the practicality of how or what climate change has caused to several countries. So my thinking is, Yannis, if you got in a matrix for those papers reviews in a systematic manner, your paper would be of very, very, very big value. Secondly, if I ask, what would be the role of banks here? What should be the role of banks, and how can the banks come in, for example? Because climate change is always done by companies at the extreme end who go and deplete the environment, etc., etc. Now, what can the banks do? Copying from the presentation you made, actually your information on the banks of Japan, what can we pick in line with what Japan is doing? How can we further combat? What can we pick from there that we can replicate and combat climate change? Should we go the Japan model, or should we go the Professor Murinde paper model? What would we go for that can actually help us in combating all this kind of climatic change?
Okay, sorry, Slide. I'm going to cut you short because we are running out of time when there are two other people asking questions.
Thank you so much.
Yeah, thank you so much. Thank you. Very pertinent points. So very quickly, Dr. Anthony Simpasa from the African Development Bank, and then Mary Longo Nketani from the Bank of Zambia. Please go straight to the question in the interest of time.
Thank you, Prof, and congratulations, Yannis, but also a good discussion by Oswald. My point is just to draw Yannis's attention to our report of last year, the African Economic Outlook, which essentially looked at the energy transition, and we discussed at length the climate justice, in which we also estimated the carbon credit and the carbon date specific to African countries. So in there, you will see the extent to which these issues that we are raising on climate justice and how African countries are owed by the global north substantial amounts of resources that they need to be compensated if we are to achieve this climate justice. So it's just to underscore the point that he has raised. And this is the issue that we are taking forward in this year's report as well, looking specifically on the role of the private sector in financing climate change. So I just thought I should add to these important points. And you can find those numbers in our report of last year. Thank you.
Excellent. Thanks very much, Anthony, for pointing out a very useful resource and very timely. Then finally, Mary Longo Nketani.
Okay, thank you so much, Professor. I've got actually a number of points that I would like to bring out, but in the interest of time, I think some of them I'll just put them in the text, in the chat. I think what my contribution is to response to Dafermos's paper, whose work I've really enjoyed reading actually, because like you mentioned in the introduction, he's done quite a lot in this field. But the issue is I like the way the gap, the way he's bringing out the gap in this research to say the problem is climate change and he's looking for an effective response to this climate change problem. And noticing that much of the problem is actually coming from the West, from the developed world, and then trying to introduce a system which is then supposed to address this gap that has been created in the pursuit of development in the earlier years, in the Industrial Revolution and all those periods, which is now over time has accumulated into a phenomenon known as climate change. So it's a very timely paper and very useful for our time. And I also like the way it fits into one of the major, I think this is one of the major achievements that the Global South managed to do in the COP27. I think the loss and damage clause that was introduced into the Paris Agreement during the COP27, I think speaks much to the work that Yannis is bringing forward here. So my conclusion or my contribution to this discussion is that given the framework of a justice system, I feel that coming with an economic mind, we need to place this justice system or structure it in such a way that it works like in a similar manner to a tax system, where you don't necessarily have a choice as a citizen. In this case, the citizens from the north, but a system that automatically is able to get the payment, maybe through production. Well, there's already tax system, well-advanced tax systems that already exist. And I think it's just a matter of looking at which one would be appropriate in terms of getting the compensation that the Global South should get from the global North. So my contribution is taking a closer look into the tax system, some kind of a global tax system, which gets from penalizes the ones causing global emission or climate change, if you like, and then compensating it into development programs in the Global South. Thank you, Professor.
Brilliant proposal. Thanks very much, Mary Alungun Keitani. Brilliant proposal. Now, we have only 2 minutes left. So I will give 1 minute to Yannis and 1 minute I will conclude. So Yannis, you have 1 minute.
Thank you. I mean, it's impossible to respond to all these comments, which were all great, very insightful. I also want to thank Oswald so much for the comments. I mean, I want to say so much based on your comments, but I don't have the time. Perhaps I'm going to take into account all your comments, of course, in order to improve the paper. Maybe the only issue that I can very quickly mention is that I very much agree with what you said about ESG and the importance and how they can be used. And the fact that we now have new frameworks in order to analyze accountability, I think is important. What is missing in social and governance indicators in many cases is what I mentioned about the green extractivism. It's very difficult to find specific data about that. It's very difficult to find data about carbon offsets. And my view is that we need to improve that. And right now, this is not the case. So I think the direction is correct, But because of the fact that we don't have this information that is related with climate justice, I think we are not still there, and I would like to see more improvement in terms of that. I don't have more time, apologies, but I very much hope that we will have the chance to get back to these issues and give some responses to all your comments. But they are extremely helpful. I very much appreciate all of them.
Thank you so much, Yannis. Thank you so much, Oswald. Thank you very much, participants. I think the interest of this actually underlines that we should have a 1 day or 2 day conference on this theme, and that's what we shall work, across, so that we can give you a lot of attention for people to bring in all sides from research, as well as empirical, from accounting, from practitioners, and we shall do that. So thank you very much, and bye-bye.